Well, hey there, everyone. Welcome to Chart This with Dave Keller. It's Tuesday, June 10th. I'm your host, Dave Keller. Happy to be with you here on a beautiful Tuesday afternoon in Redmond, Washington. Sky is clear. It's sunny out. It's a beautiful day. Pleasure to be with you here talking about the markets. I mean, generally a pretty positive session, as we're going to find here in a few moments. Not a huge update for the S&P and the NASDAQ, but a nice continuation of the optimism that we've seen so far in the course of this week. I think the big question mark now is going into tomorrow morning. We've got the CPI data coming out tomorrow, 8:30 Eastern, PPI coming out on Thursday. Those two numbers could be quite meaningful for sure. Those are the kind of numbers that, again, a good number in line with expectations or even better could just juice this market and accelerate this move that we've seen so far in the month of June. On the other side of it, though, a miss in one of those, suggesting, inflationary pressure starting to increase in uncomfortable ways for consumers. That's where things could start to get weighed down. A lot of optimism getting priced into these markets right here, arguably in a ton of optimism, and as a result, risk assets keep pushing to the upside. And it's not just equities. We're seeing it in the cryptocurrency markets with Bitcoin up today, Ethereum accelerating to the upside, even outperforming Bitcoin so far this week. With that in mind, let's get to our market recap. But I think first off, the question on everyone's mind, the rooster report from Redmond, Washington. Here are a picture of the two roosters, which my kids have named Greg and Harold for an unknown reason. That was what my son picked. So overall, they're alive and well. They're getting fed. They seem to be very happy. This is the bobcat right out of our front door. We took out. That's about 20 feet from our front door a couple days ago. So that's the excitement. That is the pot brewing here in Redmond, Washington. An uncertain, a resolution. But the bobcat has not been nowhere to be seen. The roosters appear to be coming and going. So overall, I guess the ecosystem is working out just fine. We'll see. We'll keep at it. For now, though, let's talk markets and talk charts. The S&P 500 up just over 0.5% today. 60.38 will be the close, just slightly above there. That's 0.6% higher. The NASDAQ composite about the same. Mid caps, small caps, all up as well. The small cap S&P 600, the best performer on this group. And the VIX continuing to push lower, back below 16. So we're in a 16 handle. So we, again, VIX in the mid-teens means low volatility, low uncertainty, should be relatively low risk. And as a result, risk assets like equities and other items continuing to push to the upside. So the S&P now firmly pushing above 6,000. That's after yesterday's eclipsing of that level. It's kind of a big round number, so kind of a question mark as to whether the S&P will push above there today. I would say that question being answered with an upside follow-through day. Interest rates, and I'm super excited to share with you the next episode of the Market Misbehavior podcast. Hopefully will be out for you tomorrow morning. George Noble, who I've known for a number of years, met George years ago in my Fidelity days in the Boston area. One of the first Fidelity fund managers, the first international portfolio manager out of the Boston office, ran the Fidelity Overseas Fund with some exceptional returns in the mid 80s. Was an intern for Peter Lynch. That was his first job in the industry, and also a successful hedge fund manager. Now runs a podcast, runs a sort of a media operation, does a lot of spaces. Also just hosted his first investment conference last week. So great conversation with George, and we talked about liquidity. We talked about interest rates. We talked about the dollar. We talked about the difference between the nominal value of the S&P and the real value of the S&P. And I have a great chart that George and I talked about on the podcast, which I'll share with you. Keep your eye peeled for that. That should be on our YouTube channel tomorrow, most likely, maybe this evening, tomorrow morning. We're also now on all the podcasting platforms. So if you get your podcasting on Spotify or Apple Podcasts, you should see Market Misbehavior with Dave Keller on there as well. Do me a favor and subscribe. Tell your friends. Much appreciated. Having said that, interest rates not a big movement day today. George and I talked a lot about the prospect of higher rates and what that could do. How high is comfortable and how high starts to get uncomfortable on something like the 30-year bond. For now, basically unchanged from yesterday. The TLT was up about 0.4%. rates essentially flat, dollar essentially flat. I would argue this is probably queuing up for, we've got some treasury auctions coming up. We've got inflation data starting tomorrow morning. I think that's the big thing. And then obviously any update on the situation with U.S. and China relations, still sort of waiting for Godot on that one, as it were. All right, looking at the commodity markets, again, kind of a quiet day here. You can see gold finished flat for the day, silver about 0.5% lower. Crude oil prices slightly lower as well, although the energy sector ended up being the best performer today. On the crypto side, you can see Bitcoin drifting a little bit lower here, although it did briefly get above 110,000 going into today's session. Ether price is up 3%, so around 2760. Bitcoin is just below 110,000. So Bitcoin is literally testing all-time highs. Ethereum pushing up to 2,800. So we're certainly seeing a renewal of the uptrend phase, a retest of those significant previous all-time highs for Bitcoin. And we'll see if there's enough upside momentum to continue. For now, I think those charts are strong and getting stronger. Innocent until proven guilty, as I like to say. You know, looking at the sectors, again, kind of a quiet day for the major averages, but overall a pretty solid day in terms of sector returns. You can see 10 out of the 11 S&P sectors managed to get in the green today. Energy is your top performer, up 1.8%. Communications services, number 2, up 1.3%. Consumer discretionary, the XLY, up 1.2%. So 2 of the 3 FANG sectors at the top of the list, energy beating them all. You know, energy keeps coming up, right? And we've talked about that double bottom pattern in crude oil, which appears to be holding. We've talked about the upside swing in crude oil prices and identifying levels that it needs to get above. It sort of keeps getting those and pushing above them. The energy, I would say the average energy stock is still not a great chart, but they're starting to look less bad. It's starting to look pretty good, particularly with days like today with energy leading the way higher. On the downside, industrials, the worst performer today, down 0.4%. I did grab a chart or two in the industrial sector. I forget what it was. It wasn't Raytheon. Eaton Corp, I want to say, a Northeast Ohio company. I think that was the one I grabbed. You know, the industrial sector has been one of our favorite stories in 2025. Top performing sector, certainly out of the April lows, I think surprising many probably in terms of the strength that we've seen. You know, defense stocks, aerospace stocks, a big part of that story, but it's not just those. Eaton's a diversified industrial company, basically, and pushing to the upside. However, what we've seen here in the last couple of weeks, 2 sectors in particular starting to weaken on a relative basis, industrials and financials, and those 2 happen to be at the bottom of the leaderboard today. We sort of had a resurgence in that value space, and those 2 sectors in particular did better than others within that sort of value orientation. Insurance companies have been a top performer in the financial sector. They are all getting dinged. We highlighted that on the show. Industrials have been a top space with aerospace, defense, with other industrials. They're starting to pull back a bit. Charts like Eaton Corp flashing divergences. The industrial sector as a whole, I believe, flashing a divergence as well. We'll dig into those a little bit, and you'll see what I mean, and why it may be an interesting time to think elsewhere. To be honest with you, if you've been riding those to strong gains. All right, looking at the breadth conditions, we can see overall pretty positive day, about a 2-to-1 ratio in the S&P 500, 66% advancers. In the small cap index, you can see 72% up. The New York Composite Index, sort of a broad list, 62% up, 35% down. So generally, the breadth has been pretty constructive here. Decent day with the average stock gaining some ground here. All right, let's look at the Magnificent Seven. Tesla getting a nice bounce today. This is after getting absolutely clobbered going back to last, I think that was last Thursday, where we had that big move lower. It was down 20-some% intraday, ended up closing down about 14-15%. That was the Trump-Musk breakup, for lack of a better summary comment of what happened there. And today getting a bounce with news that the robo-taxi experiment may be rolling out pretty quick, looking for imminent news along that front. Tesla, the best performer here, up almost 6% today. Alphabet up 1.4%. Meta up as well. On the downside, Netflix, which has again been the best of this group of charts, although starting to look less awesome with some of these others like Microsoft and others having pretty good runs as well. but Netflix down 1.7%, Microsoft slightly lower, Broadcom slightly higher after chopping around after that trend line break that we highlighted on the show. All right, I do see some great questions coming in already across the board on YouTube, X, Facebook, and LinkedIn. I appreciate you guys tuning in live. Those of you that are doing so, please drop questions as we go. I'll keep an eye peeled, and we'll take a question or two before the end of the episode. Any of the questions we don't get, we will put in our mailbag, and we'll plan an all mailbag episode at the end of this week. Quick heads up, and to be totally honest, I haven't exactly figured out what I'm going to do along these lines, but I am heading out. I'm heading actually to Boston on Friday of this week, and then all next week, I'm actually in a music camp for adults in New Hampshire. It's called the Walden School. It's a really cool place where composers, performers all get together for a week up in the mountains. You kind of unplug as much as possible, play music, experiment, try things. It's a great creative opportunity that I'm super excited to participate in. What that means for my show, not 100% ready to announce yet, but I'll figure that out. Got to work on that here in the next 24 hours. I'll give you a quick update. My hope is to just do a briefer update, probably not live, but just do a quick video on my YouTube channel to keep you updated and take a quick look. But I do want to let you know, probably an adjusted viewing schedule here coming up next week. All right, let's look at the heat map. The market carpet is a great way of visualizing market activity, sort of the overall configuration of these markets, but then focusing on specific opportunities. I mean, very much sort of a mixed bag of colors here. We can see quite a bit of variety. This was not an everything up kind of day, although more stocks were positive than negative, granted. However, when you look, you'll find in most sectors, there's some things that were working and some things that were not. So particular names and themes to highlight. I would say, this week seems to be like the week of semiconductors. Maybe this month it's semiconductor month here on Chart This, because we have Micron, we have Lam Research, we have KLAC, we have Applied Materials, Intel even, which is sort of an outlier in the semiconductor space. All doing quite well today. NVIDIA, of course, the largest name in that group, up about 1%, which isn't an incredible update, but it's certainly continuing that uptrend off of the April lows. It's the rest of semiconductors really, pushing to the upside. So we've got renewed optimism on the growth trade, renewed optimism for AI, for chip manufacturers. That whole theme, which was sort of on ice in the second half of May, now reinitiating to the upside here in early June. Within the technology sector, not a lot of things that were down, but you'll see things like Salesforce, which has actually been trending downwards over the last month. Cisco, which actually made a new high yesterday. ServiceNow trying to hold that $1,000 level. And then you get to like GEV, which has been, again, a top performing stock, made new all-time highs earlier this month. But so far from that moment on, the rest of June has been pulling back. So what's interesting is with charts like GEV, there are a number of charts like that have actually been very strong charts, and they're starting to rotate lower a little bit. Raytheon is another example. That could just be a brief pullback. And arguably, if you're real bulled up on GEV and RTX and other strong uptrend names, you could make the argument that the best thing that could happen for the sustainability of the uptrend is a tactical pullback, right? A higher low where investors that miss that, that big up move off of the April low have an opportunity to buy in on the dips. We'll see if that happens. But I would say with the charts of GEV, with RTX and some others, we're seeing pullback on some of the top names that have actually had arguably some of the best charts from the April market low. Keeping a watchful eye on the financial sector, as always. Noting that both Visa and MasterCard pushing to new all-time highs this week, or very, very close to doing so. Those have been probably consistently some of the stronger names within the sector. Others like JP Morgan, Bank of America, attempting to break above short-term resistance, which is encouraging, but it's not sort of a all or nothing, right? I mean, some of these names are actually down a bit today, particularly the insurance companies. We can see PGR breaking down to a new monthly low. We highlighted that on the show yesterday. AJ Gallagher, other insurance stocks continuing to underperform. So it's sort of like payment processors, banks, good, insurance companies, bad. And that's flipped from the script that we had not too long ago, which was insurance sort of the outlier doing so well, while the other areas of the financial sector struggling a bit. Within communication services, besides Netflix being down today, the rest of the sector was actually quite good. Alphabet and Meta up, which is good. AT&T and Verizon up. AT&T pushing to a new all-time high today, depending on whether you're adjusting the data or not. But I think the real story here are media companies. Disney making a new 52-week high today. Comcast nowhere near a 52-week high, but at least breaking out of resistance. Here's the chart at Disney. Now, fair point, not quite a 52-week high. Sorry, I missed. It actually is a 52-week high, but it's not an all-time high there. That was the March peak, but from last year. However, a nice upside follow-through. And what's happened now is Disney has 100% retraced from the February peak to the April low. We've gotten all the way back up to those previous highs. So charts like Disney starting to improve. The media space within the communication services sector, most important. I do own Disney. I don't own a lot of individual names, but Disney is one that I do own in my accounts. I think that's it for the market carpet. Other thing I would note is within the utility sector. This is an area to watch. We've had some really good up moves in charts like NRG, CEG, Constellation Energy, Vistra Energy, all coming off the April lows. All three of those names were down. Other things were doing okay, but those have been some of the top performers within the energy sector that are pulling back a little bit. So you're certainly, at least I'm starting to get that feeling that some of the leading names that had been doing so well off the April lows in some of those thematic sections that we talked about, pulling back a little bit. Too early to say that's a major top or some very bearish activity. Could just be pullbacks within uptrends, but certainly a theme to be paying attention to. And then finally, how about energy continuing to show some green back at the top of the leaderboard today? All right, let's look at the charts. I've got some charts that I hand selected through the course of the day today. I've got some questions here we can get to, and keep your questions coming. Anything we don't get to on the show, we'll get into the mailbag and answer as soon as we can. All right, on the S&P 500, again, I would characterize this chart as innocent until proven guilty. There was a point earlier on in this move off the April lows where I think it paid to be skeptical, or at least I was very happy being skeptical of the uptrend phase. If you followed my show, again, my goal is to focus on the evidence and to focus on what the trends are telling us. And I think one by one, any objection from trendline resistance to moving average resistance to Fibonacci resistance, all of those things have been broken at some point from early April now to early June. So at this point, I think you have to recognize that the equity markets are in a pretty consistent uptrend, and pullbacks have been what's been most telling here. Particularly the most recent pullback with the S&P pulling back to an ascending 200-day moving average and bouncing higher. This is a market that is innocent until proven guilty from a technical perspective. Plenty of things I think that could weigh on this market. Maybe inflation tomorrow is one of those things. But from a trend following perspective, I'm following a trend higher, which I think is pretty clear. I did a show on Stock Charts TV earlier today. I don't know if that's posted yet, but I would tell you that we as soon as it's ready, it was all about divergences. We talked about the S&P 500 chart. We mentioned this on the show yesterday. It's too early to be declaring this any sort of bearish divergence, even though we are moving higher on the momentum, not as high as it was in May. But since this is an active uptrend, that RSI value is sort of accelerating at the moment. So it's too early to sort of, declare it a divergence. It's a potential divergence, but not there yet. You have to wait for a peak, a secondary peak, so then you can confirm what the momentum actually was as the peak was established. Too early to say. I think for now, it's still an uptrend until proven otherwise. I think, again, generally, from a line in the sand approach, I think it's that 5750-ish range. 5,800 is the 200-day moving average. I think anything above there is fine, is okay, is noise. Anything below there, you have to sort of question the sustainability of the uptrend. But for now, the uptrend is in good shape. And one of the things we've seen starting to change in June, and I think we've seen a couple kind of changes of character in the market so far in 2025. Going into the February peak, this was probably the first stage where we're making new highs, and it felt like a continuation of the 2024 peak, but we were starting to see divergences in breadth and in momentum. We then had the sell-off phase from February to April. Tariffs were midway through there. That was actually down here after the markets had already sold off and the S&P had broken the 200-day moving average. But I think phase two was that downtrend phase. Phase 3 is coming out of extremely bombed out levels with this V bottom period, accelerating back to the 200-day moving average. I think phase 4 is sort of this leadership rotation we saw in mid-May, where the S&P and the NASDAQ kind of stall out a little bit. We start to see some other areas of the market, defensive sectors, improving a bit on a relative basis, sort of questioning the sustainability of the uptrend. Maybe we're now into that next phase, which is a resumption of the uptrend, right? With growth over value, with offense over defense, with breadth conditions improving. Breadth was deteriorating in late May, and now it's improving now in early June. This chart sort of shows that, by the way, with the over 50% of S&P members above their 200-day moving average, with over 75% of S&P members above their 50-day moving average. Those are bullish readings, right? The bearish readings are when those things are not the case, right? When we break back below 75% on the bottom indicator, on this middle indicator, which is stocks above their 200-day, less than half is kind of a bearish reading. That last big sell signal we had was in early May, suggesting that we're really in a corrective phase. It's kind of holding that 50% level, even with the chop that we experienced in the second half of May. So for now, I would say indicators that I follow that we're getting questioning the uptrend in late May, sort of reinitiating in a bullish reading in early June. All right, I mentioned the episode coming up here with George Noble on my podcast very, very soon. This is one of the charts that we talked about, and we talked about a version of this, but this is basically comparing the S&P 500 in nominal terms versus the S&P 500 in real terms. Now, what do those terms mean? If you've not heard that before, in the financial industry, we would often talk about, the impact of inflation and what that means, and what are the ways you can sort of describe returns is doing real returns versus nominal returns. Nominal returns are what the index is telling you, right? This is the total return of a particular thing, stocks, bonds, an ETF, an individual equity, whatever it is. The real terms are basically when you adjust for inflation, when you see what the value of that thing is in an actual consistent thing, right? In terms of, actual money and the purchasing power of your dollar, that's in real terms. Because if the S&P goes up 10%, but prices go up 10%, you really didn't gain anything, right? You gained 10% in nominal terms, but you gained 0% in real terms because you're not making more than inflation, right? And so that's a way of sort of normalizing movements and longer term returns by adjusting for how much your dollar or whatever you want to base it on is actually worth. And what George and I talked about is basically adjusting the S&P by looking at it in gold terms, looking at it in terms of hard assets. Now, gold, of course, has had its own story, and it's testing new all-time highs, or very, very close to that in the last month for sure. But this is a weekly chart of the S&P 500 going back 10, 15 years, it looks like, going back to mid-2010. So a 15-year chart, you can see on a log scale just this incredibly beautiful uptrend phase with pullbacks in 2020 and 2022 and some other random points along the way. But overall, a pretty consistent uptrend. Even with the COVID drop, you can see the long-term argument for equities here. Now, the bottom panel is that same series, but adjusted in terms of gold. So here's the S&P basically in dollar terms or in index value terms, really. And here's the S&P in terms of gold. If you look back, and I'm not going back to 2000, but the all-time high for the S&P 500 in nominal terms was in February of 2025. The all-time high for S&P in gold terms was in 2000. We're still nowhere near the 2000 peak. If you look at the S&P in gold terms, that's another 10 years off the left side of this viewable area. But if you bring up the chart on stock charts or some other platform, you'll see what I mean. Also, while the S&P is currently testing all-time highs, when you adjust in terms of gold, the S&P is actually back down to the COVID low. We're actually where we were in 2020. So this is what the index has done in terms of the value of the S&P, basically over doubling from the COVID low. When you look at the S&P in terms of gold, you really haven't made much ground at all. This is why we talked a lot in 2024, why this was a very unloved bull market, why the bull market didn't feel as good as it seemed like it should with the S&P at new all-time highs. I would say this is part of the story. The S&P in gold terms was kind of trending downwards, if not kind of flat during that period. So the real value of the S&P 500 is actually at its lowest level in the last 8 years or so. So that is one of the interesting charts we talked about. We'll come back to that in the interview with George Noble. I hope you will enjoy that. But again, before you get too excited about how awesome it is that the S&P is doing what it's doing, and to be clear, I'm thrilled the S&P is going higher. It would be much better, though, for all of us if the S&P was actually going up a lot better in real terms, in terms that actually meant what the value of that capital growth actually meant for us and our ability to use that capital for other things. Cryptocurrencies, by the way, are moving to the upside. We talked about gold near all-time highs, silver, of course, in a primary uptrend as well. Bitcoin, Ethereum, all re-exerting this uptrend phase. Bitcoin just in the last month has made a new all-time high around 112,000, has pulled back to the ultimate big round number support at 100,000, and now is rotating back to the upside. It's currently just below 110,000 as we're going here. I think we talked about this on the show yesterday. It's a bit of a blur, but overall, there are a number of arguments to be made for something like Bitcoin and cryptocurrencies and blockchain technology. That's something for a topic for another day. I would say from a purely technical perspective, I like the fact that we pulled back to an ascending 50-day moving average. I like the fact that we held an ascending or that we held big round number support at 100,000. I'm thrilled that the RSI held 40 because that's one of those kind of basic litmus tests as to whether a pullback is kind of an okay pullback within an uptrend or whether it's something more significant. The RSI pushing below 40 is often the sign that things are getting pretty ugly, maybe a lot uglier than they have already. For now, Bitcoin in a primary uptrend and maintaining that. And I would say this week so far, we're seeing a retest of those previous all-time highs. Break above 102, 103,000 really clears the way to uncharted territory, pun intended. Now, Tesla, I just wanted to highlight Tesla, the top gainer within the Magnificent Seven, up almost 6% today. Sort of a news TBD very, very, very quickly about the robo-taxi rollout or some announcement relative to that, I'm told. But I just wanted to highlight from a technical perspective, if you look at the April low on Tesla and you look at the high from late May, and you go 61.8% of the way down, that's 272, is pretty much where we bottomed out on Thursday after the sort of big social media feud between Trump and Elon Musk. From there, we chopped around yesterday, a nice update. Today, a follow-through day. Yesterday, we closed above the 200-day. Today, we pushed above the 200-day and also pushed above that 38.2% level. So I think that's your new kind of short-term floor, which would be the 200-day to that Fibonacci level. It's around 306 to 310. On a name like this, I don't have a position in Tesla directly. I'm sure ETFs I own have some Tesla in there for sure. But when you have a chart like this and you break out, great idea, I think, to look for what I call a natural stop, right? Clear levels on the chart that seem meaningful. To me, there's two levels that stand out. This kind of 310 level, which would be the Fibonacci support, and also basically the 200-day, and then the 61.8% level, which lines up with the low from last Thursday. That's around 270 to 275. Those would be some levels to keep an eye on for sure if I'm looking at that stock in particular. All right, two sectors at the bottom of the leaderboard today, and both starting to rotate in a negative way if you look at the relative strength. Here's the XLF, which is the financial sector. In absolute terms, if you look at the top panel, we had the peak in around Thanksgiving of last year. We basically briefly broke above there in January, February, stalled out around 52. We can see that in May, we retested that resistance and pulled back. Now we're sort of in wait and see mode as we remain below that resistance level. But here's the problem. As the financial sector is stable on a relative basis, you're underperforming. Because that's because other sectors like technology, semiconductors, others have done much better. They've been in uptrends while this sector is sideways. So the relative performance is starting to rotate lower. You find a similar thing in the industrial sector, as we'll get to in a minute. But first, I want to highlight Arista Technologies. Arista is one of those, again, when so many stocks are at their 200-day moving average, I think that's a great way of differentiating what's working and what's not. There are at this point just over half of the S&P are above their 200-day moving average, which means just less than half of the S&P are below their 200-day moving average. And I think which bucket you're in could mean a lot. Arista Networks today breaking back below its 200-day moving average. Stocks like this that are unable to hold the 200-day, I think, deserve a great amount of skepticism, particularly at a time when most things are back above. So this differentiates itself with remaining below the 200-day moving average if it would do so. Keep an eye on Arista breaking above 100, which is big round number resistance. Also the peak from mid-May, I think, would open the door to maybe a potential retest of the January peak. But until then, I'm skeptical unless we can get above the 200-day. Here's the industrial sector, and I would say the XLI kind of similar to the financial sector, although it did get above that Thanksgiving peak in May, and then again over the last week. Here's the problem. We do have what appears to be a bearish momentum divergence of higher highs in price, lower peaks in momentum. The relative strength is just starting to turn down. It's not end of the world bad. It's still kind of within a trend line you might draw off of the lows, but certainly something to look at. Look at a number of times here where you had an uptrend in relative strength and then a break, and that was usually just the time you didn't want to be in industrials. Whether or not you were losing a lot in absolute terms, you were probably just losing the opportunity to own other things that were doing much better during that particular period. One of the names within the industrial sector down today, Eaton Corp. Others within the industrial sector have done better than Eaton off of the April low. And, indeed, in primary uptrends at new highs here in June of 2025. But I want to highlight Eaton. I'm just looking at the closing prices because I found a lot of times if you're really trying to focus on divergences, sometimes the intraday movement can be a little more noisy. And so just looking at the closing prices can make it much more easy to detect divergences where price and momentum are doing different things. I've highlighted with these red trend lines a number of times over the last year or so where we've had bearish momentum divergences, higher highs in price on weaker momentum. And the last two major pullbacks sort of were punctuated beforehand with a weaker momentum reading going into what ended up being a major high. We moved slightly above the May peak on a closing basis last week. And you can see that comes on weaker momentum. We're overbought on this move to 330 in mid-May. We're now below the overbought reading as we retest 330. So within the industrial sector, seeing some signs of weakening relative strength, seeing some divergences in financials and industrials, which tell me maybe there's a pause in that trade happening. Eaton holds its 200-day. It's not a bad chart, but that's a big if right about now. All right, let's take some questions. Yeah, I do see the comments about Smuckers. Smuckers is one of those names. There's a thing called home bias, which is a well-documented behavioral bias where you tend to focus on companies near you. If you're depending on what sort of portfolio you run, international investors often invest in stocks in their home country, even though things elsewhere may look obviously much better. Even regionally within the U.S., it's been documented that you tend to think more highly or have a connection to companies that are located near you. And I say that because Smuckers is based in Northeast Ohio, where I grew up and where I lived a time about 6 to 8 years ago with my family. And so I always pay special attention to Smuckers, and it did rotate to the downside in a pretty big way. Not a bad chart until today, but certainly not a great move today. But a great reminder of home bias. Let's see here. Give me a moment as I flip. There's quite a few comments and questions here. Ooh, I won't try to pronounce your handle, but thanks for watching on YouTube. Claters? Have you checked the RSI of XBI by chance? It's been leading the market along with semis for the last 2 weeks. Yeah, that's a biotech ETF. There are a couple biotech ETFs. XBI is one. IBB is the one that I use more, and I don't know why exactly that I do. That's just one of those things. Maybe that was the first one that I looked at, and I just haven't forgotten it. But those fairly interchangeable by my sense. But just different providers covering the same space. 100% right. XBI is actually a pretty constructive chart. And we have randomly mentioned this, that within the healthcare sector, there are things that have done well. And in the last week or two, we've seen a real nice bounce higher in some biotech names. And I think we highlighted those on an individual stock basis when they looked pretty good. I don't remember looking at the biotech ETF in a while. I mean, so honestly, right, higher highs, higher lows, right? If you look at the low in April, we have a higher low in May. If you look at the high in early May, we have a higher high in June. So this is a trend that has gone from a downtrend, a distribution phase, to an uptrend, an accumulation phase. Now, the question mark I have when you have a market sort of recovering like this, especially when we try to make a new high, are we doing so on stronger momentum? And I would say we are, right? The RSI is above 60 on those upswings. And what you want to see when a market's in a downtrend, the counter trend rallies, you often get it stalling out just below 60, right? So there's enough momentum to sort of make a new peak in the price, but not enough to really make new swing highs, and not enough for the momentum to be more constructive. When we make a new swing high with the RSI above 60, that's often a really good confirmation that that things are really starting to rotate higher. So I would say that is actually a pretty compelling rotation within the healthcare sector, which I would say still, broadly speaking, is not my favorite sector by any stretch. I would say biotech within there actually improving quite a bit here. And I do see some comments here. Absolutely right. I was going to, as I was saying that, I'm like, there's something about the biotech ETFs, but the weightings are different, some different holdings, and certainly the concentration is different as well. So thanks for highlighting that, Bull Bear Jeff. I appreciate it. Let me take one more question, and we'll call it an evening here. Bull Bear Jeff, because you so kindly weighed in about the biotech ETF, so I'll answer your question here. Bitcoin has some significant bearish divergence on daily. Shall we look? I actually just had it up here. So let's go. So I don't know about that one. I don't know if it's significant. So here's the thing, right? It's not really a divergence yet. I think what you're highlighting is the fact that we're pushing higher, but the RSI is nowhere near where it was here. Maybe, right? And maybe. So this is a fantastic example of a bearish divergence. I think when in future textbooks on technical analysis, I think highlighting, this kind of thing, the S&P going into the February peak is up there with other major topping patterns. I mean, we're making new highs. We're pushing above highs from way off the left side of the screen. And we do it with the RSI that was way overbought in November and not overbought in mid-December. That's a clear bearish divergence. That could be what this eventually looks like, but it's too early to say. Right now, you actually have the price going up and not making a lower peak yet, right? We're sort of still in an active uptrend. So I think you have to be careful with a chart like this to call it a divergence yet. You probably immediately see this and your brain says that's a divergence, but it's actually not. These are actually agreeing right now. The value here is that we're making higher price highs on weaker momentum. So the way I always think of it is you start here, you look for the price, and if it makes a new high, you look down to see if it's on stronger momentum. And if not, then that's a problem. But if we're not making a new high yet, you don't really have to check the divergence because it's not a divergence yet, right? I mean, it's at this point, the price and the RSI are kind of doing the same thing. If Bitcoin would kind of get up to here and then the RSI would remain about there, then I would say 100% that is an obvious bearish divergence. At this point, not there. They're actually not diverging. They're actually in agreement right now. But thanks for highlighting that because that could turn into a divergence similar to the S&P. Just too early to tell, I think, given the fact that we're currently pushing to the upside. Great questions as always. Thanks for watching. Thanks for making it interactive. And thanks for some thoughtful comments along the way. I appreciate you guys so much tuning in live. If you're watching our replay on our YouTube channel, I appreciate you as well. Please put questions as you're watching the show in the comments section. We'll gather all those questions and hope to answer one of yours in our next mailbag episode. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.